Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today you can hear it in my voice, huge amount of excitement because I have the #1 performing manager of last year. Guys, ROI 389, we'll call it 390% between friends, an amazing year. Has shot to superstardom in the Twitter sphere, which is of course what it's all about these days. I'm wearing my best green shirt because we have Mr. Josh Young from Bison Interests on the channel. A quick bit of housekeeping, guys. Anything that we say today is just opinion. It's a conversation between two guys that genuinely love investing. So please do your own due diligence before making any decisions. None of this is to be considered solicitation, investment advice, or solicitation to invest. Having said that, Josh, welcome to the channel. Thank you for joining me. How are you doing, sir?
Yeah, thanks for having me on. I'm doing as well as I can, considering I think oil's down $10 this week.
Yes, we have seen some rather large gaps, ups and down. We're going to talk about that, guys. We're going to talk about a little bit of macro commentary, where we are in this, particularly CapEx cycle is what I'm interested in getting Josh's thoughts. We're going to talk specifically to oil and gas. Everyone knows you, Josh, as an oil and gas investor, but you are, I would say, at heart, a value investor who chooses to focus in the oil and gas space. And we'll have our favorite ROI segments where I really get to delve into some of Josh's experiences in terms of the investments he's made and the returns he's been able to achieve on those investments. Josh, I would like to begin with perhaps maybe a 2 to 5 minute introduction into your background. Now, you began as a fairly conservative value investor, Chicago education, efficient market theory, all that sort of thing. And yet you grew up in California, I believe, and you somehow find yourself in the oil and gas space in Texas. Give me maybe a 2 to 5 minute introduction to yourself as a person and how you got involved in investing and how you ended up running Bison Interests.
Yeah, I'll try to keep it on the 2-minute side, but we'll see what I can do. So I'm from LA originally. I used to read the newspaper every day, cover to cover, as a kid and a teenager, and it was really cool and exciting. And there was a Motley Fool newspaper column that I would read, and once I sort of cobbled together some money from babysitting and birthday gifts, whatever, I started to invest based on what they would talk about, as well as other sort of similar columns as a teenager. And so I've been interested in investing personally for a while. Went to University of Chicago, was sort of taught that there's not really that opportunity to outperform in the market, and that any outperformance I might have experienced was either luck or just sort of coincidence. So I went to do management consulting, which was sort of the most similar to studying economics, but with some real world applications. Went from that to private equity, which was just sort of more explicitly managing the businesses and then also owning them. And then worked for a multi-billion-dollar family office where I got to actually get paid to start investing in public equities, and did really well there. Left to launch my own long short hedge fund, which was not good. It was like post Madoff, so you couldn't really like raise money. It used to be that you could launch a hedge fund on your own and sort of get to scale, and it never got to scale. It was just a bad idea to try to do it on my own, as I think it was like 24 or something at the time, 25. So after oil prices crashed in 2014, I started to spend more time with a friend who was helping manage various family office money at a large investment bank. And we realized that there was this great opportunity to come in after oil and gas investment had collapsed, that inevitably the valuations of these businesses would improve, and that there was just sort of this opportunity to come in and own these stocks for a defined amount of time, and applying some of the special situation approach that I had been doing previously and building a portfolio of companies with that sort of special situation, deep value approach. There was an opportunity to essentially, I guess, for lack of a more glamorous term, play the cycle and get exposure inexpensively, buying stuff at a big discount to replacement cost with the expectation of being able to sell. And, we thought it was going to be about 3 years, sort of on the long end. And here I am 7+ years later, and my business partner, we're still friends. He left Bison several years ago now. It just took too long, and he really wanted to move on to the next opportunity, which for him was starting a private education fundraising business.
Okay, excellent. Yes, I think that this cycle has taken a little longer than most of us had expected, but that might be the proverbial beach ball underneath the water that's going to rise up higher on the upside on the other end when this is all said and done, we hope. I really want to delve into your process of valuation. What I might do first is just briefly touch on some of the macro themes that we are seeing recently. So we have seen the decline in oil price that you mentioned. There's some talk about whether that's liquidity driven. I mean, we're seeing like $5-10 gaps up and down, some crazy price swings. Listening to Eric Nuttall yesterday, I believe, in an interview saying that he thinks that a lot of that is just simply the fact that most people are taking the rest of the year off from the sector. And so liquidity driven price movements up and down might be contributing to such volatile swings. Looking into 2023, where do you see us in terms of demand versus supply on an equilibrium? Do you think we're still drawing down inventories? What are the key factors that you're looking for in terms of keeping an eye on the oil macro?
So I think we're at a really unique place right now for the oil macro, where there are different narratives that are essentially, it's almost like politics, where they're drawing on different facts. And so right now we're actually working on reconciling this, where there's different sources that compile global oil and products inventories, including strategic petroleum reserves, including Chinese onshore reserves, which they don't really report. So you need satellite data. And different sources have substantially different estimates for the total reserves, as well as for the trajectory of the increase or decrease in total oil and oil products reserves so far this year. And so one of the things that sort of was surprising to us, because we thought we knew what was going on, and then there was this next set of data that came out, and there were a number of revisions and divergences among the different data providers. And so I think one of the things we're seeing in the market, it's always easy to say, hey, this is like some sort of short-term market blip, and it'll just revert back to sort of this longer term trend. Having been caught off sides several times in my career from starting with that approach, I don't like to accept that approach. And when I can find a divergence in the narrative or some sort of like break point, it's less about, from my perspective, predicting the future and more just having a clear understanding of the present. So I think it's really important to understand what's happening. And honestly, as of this moment, I'm not sure which data provider is right. And that's a very odd, it's a very weird situation. So that's very important. And that matters a lot more, in my opinion, than thin year-end trading. It matters a lot more than many of the other things that people are saying from a short-term perspective. From a medium to long-term perspective, I'm not that worried. Like, understanding that the world may be building inventories a little bit this year, or the world may be seeing declining inventories a little bit this year, doesn't really matter so much to me, because of a few of the very big factors that I see overwhelming some of the sort of short-term discrepancies between the different evaluation and sort of information provider approaches and actual numbers. So it is a really weird point right now. It's very uncomfortable to not have a precise understanding of where we're at right now. And it's something that I expect, this is a Friday late afternoon that we're talking. I'd expect that by Monday, we'll know. We're doing all the math. We're like tearing apart each of these things. Maybe we'll know by Tuesday, but we'll know. But I think it's really important to be able to actually identify where there's a divergence or a variance in the narrative, as well as in your understanding, and to be deeply intellectually honest, where you just say, hey, I don't care how this makes me look. I don't care how this affects whatever existing investments I have. Like, if I have to sell something, if I have to buy something, if I have to say, hey, I was wrong about this or that. I mean, no one's perfect. And I do think I think there's always a possibility. We publish these different theses on a monthly basis at Bison, and there's always a possibility that any of those could end up being wrong or could take longer than we'd expect to play out, or could, I mean, can be very wrong, could go sort of completely the opposite direction. So I think that's sort of maybe not what you'd expect to hear, but there is just the reality, which is that with a very complex market like oil, which touches a lot of different, I mean, every economy around the world is using oil, but there are a number of different places where there are information gaps. And there's just a lot of uncertainty sometimes in the market, both in terms of inventories like we're seeing now, as well as in terms of trajectory. So all of that is sort of short term. And that's, I think, from what I can tell, the best explanation for what's happening to oil price, which is where there is uncertainty, there is fear, and people will often be more afraid of uncertainty than they are of risk. Like if they don't know what's going on, that's, I think, scarier and harder to deploy capital into and easier to bet against than where there's sort of a more defined risk situation. So I mean, we can talk about sort of the fundamentals and sort of the trajectory of things, but
Definitely.
I think it's really important to talk about sort of this uncertainty and then to just point it out. It's the elephant in the room. And, you know, I think it's important to be able to say there's an elephant and then try to characterize it. And then, you know, to as best as possible to redefine it to whatever it actually is, not just sort of a big gray thing.
Oh, absolutely. And I think that shows a hell of a lot of intellectual honesty. And of course, it's all about like results and accuracy of theses over anything else, right? Like facts should be greater than feelings, but there's obviously this risk of when you start to speak publicly about a certain theme that you run the risk of either becoming a perma bear or a perma bull, depending on what your previously published statements have been. So what do you use as your North Star then? Like if you're finding it hard to use inventory data or finding credible, reliable sources, or there's lots of different sources that are saying different things, what else can you look at with more certainty? Can you look at CapEx and say, well, look, we know that we need a certain amount of oil to satisfy demand. We're looking at rig counts. We're looking at all these drilled but uncompleted wells, the DUCs that have been basically used up since COVID. What type of indicators are you looking at that can give you more confidence in terms of where you see the trend going?
So we have a really firm grasp on world oil supply, and it's a complicated subject too, but we have a very good idea of how much oil is being produced right now and what the trajectory is in various important markets, in various important sort of sub markets and sub regions, production by certain specific companies that might be the most likely to grow or shrink or sort of deviate from the norm. We're coming at it from individual security analysts perspective. So we're digging into many different companies from many different perspectives to understand what's happening with those companies. And so we end up in many cases with these macro theses based on aggregating analysis on sort of on many different sort of contentious securities and contentious situations. So
you're calculating that essentially from the bottom up, like the aggregate of each individual company. Is that the way you're approaching it?
Yeah, I mean, so what I was saying was that in many cases we will have analyzed the individual companies that are the contributors, or that would sort of be the companies that would either make production go up a little more or go up a little less than people are expecting. So we're looking at some of the sort of marginal producers through our just day-to-day work of evaluating these companies. And then we're also looking at some of the macro models and some of the country level activity and rig counts and rig productivity and so on to sort of fill in the gaps and figure out sort of what's going on. But I think from a supply perspective, we have a really good idea of what's happening. And I think the inventory conversation is interesting because there's been this very powerful narrative, along with at least a couple of sources who have been historically fairly reliable from an inventory perspective, showing that inventories have been drawing a lot, that they've been declining, which would be price positive. And so it's this very weird situation where that's going on, but then there were other sources that show something different. It's increasingly clear that there's hundreds of millions of barrels in storage in China right now that are at best partially accounted for by some of these information providers. And so reconciling that requires coming up with a better idea of what's happening from a demand perspective. And it's always harder to tell demand than supply. And it's sort of, you can, for the last couple of years, it's sort of been the people focused on supply have been pretty bullish and the people focused on demand have been pretty bearish. And that's sort of been the dividing line. I've always had to take that I need to know both. And, you know, I think supply is going to matter more over, let's say, the medium term or longer term. And demand matters more because you can get these sort of air pockets where you go from 130 to 70 over a few months. And you can go from, I mean, it was like 130 down to 90 in a month or something like that. It was pretty, there have been these really, really big moves. So it's really helpful to understand what's going on. And hey, is like the world economy collapsing, or is it from lockdowns in a specific place, or is there some sort of behavior change? And you know, I think we have some ideas on that, and there's an error bound. And one of the interesting and challenging things about estimating demand is that you have higher probability of being precisely wrong if you try to get too precise of an estimate. And so there's just, I think one of the ways we're going to end up reconciling this inventory question is we're just going to get a more precise estimate of demand and consumption over the last number of months, and then calibrate from our assessment along with getting some other perspectives from physical oil traders and other people that we know that are doing right now the same analysis that we're doing, having realized similar problems with sources that they were using as well as that we were using to figure these things out.
Okay, it's interesting. I'd like to get, if you don't mind, your current, just as of today, where you think we are in terms of supply, million barrels a day versus demand, and then how that might change with, I guess, the big wildcards that we've all been watching. So Russian production, what's going to happen with that? We expect, well, I expected anyway, that would have really slowed. Doesn't seem to have been the case. And then China reopening, I think, is the big one on the demand side. And then, of course, we need to talk about the SPR release ending. Where do you think we are in terms of supply, million barrels a day, demand, million barrels a day? And if those, I suppose, switches were to be changed, how might that affect the supply-demand balance moving into the next year?
Yeah, I mean, so those are sort of the bigger questions. And again, like hey, we have to recalibrate some of our inventory understandings and some of the almost the equivalent of like a nowcast, like, hey, what's actually happening right this second? That's almost secondary. So it sounds really dire, but it's almost secondary because of a couple of the factors that you mentioned. So it looks like China, let's say not right now, but let's say a week and a half ago, China was using about 2 million barrels a day less oil in the form of jet fuel, along with gasoline and a little less diesel. They were using about 2 million barrels a day less than they were at the start of this year, or let's say same time last year, because of lockdowns, because of other sorts of economic controls by their sort of central government that's been forcing the sort of local governments to do this, to enforce a zero COVID policy that they've now changed. And so there's likely to be a shift or a switch over the next few months as they implement their new non-zero COVID policy, where they're essentially just ripping the Band-Aid off. I've been joking recently that Chinese politicians, so like the number two, the Premier Li, I don't remember his last name. He sounds like in his latest interviews, he sounds like a Republican politician in like November of 2020 or December of 2020. He talks about how you just need to like reopen and how people are gonna get sick, but you know, it's not that mortal. It's not that the fatality rate's really low, and how the economy at some point becomes a more important factor than people being afraid of a disease, and we have to like sort of face into it. I mean, it almost feels like they sort of the translated Ron DeSantis speeches from 2 years ago, added some Chinese characteristics and gave those speeches. So so that matters a lot because that's a massive narrative shift. And even if let's say they're going to increase demand by 2 million barrels a day, just get back to where they were a year ago. Even if they're doing that, they're not there yet, right? They're on their way. And so does it really matter if 2 million barrels a day of Chinese demand turns on right this second, or it turns on in a month or over the course of the next 3 months, like, yeah, it's going to be painful from a short-term oil price perspective, and it's going to affect world oil products inventories and oil inventories, but it doesn't matter that much. And so we'll sort of understand we have to evaluate these things, but we also understand that the trajectory, so making sure we know what's going on, but also knowing sort of the direction of things, I think it maybe matters even more. And so that's the biggest single thing in the oil market right now. And I'd say I have higher confidence than I've had in a long time about China in terms of their demand trajectory. And the thing that I think is bullish and going to surprise people, weirdly, is that every country, when they've reopened in the way that China is now reopening, has swung from using below pre-COVID level demand to, in many cases, above pre-COVID level demand for at least a period of time, with revenge travel, with revenge whatever, like people just, they go out to eat a lot, they fly places, and it's not wealth driven, right? It's not like you look at the data and you look at consumers suffering or not or whatever, and people say this isn't going to happen for China, that somehow China is different. And China is not different, just like every other country in the world is not different. And the way that they're different, I would argue, is actually demand positive, which is that they've just had the most extreme zero COVID policies for the longest of any country in the world. So I think it's sort of this coiled spring from a demand perspective, and we could be shocked. I mean, maybe we end up with 4 million barrels a day of incremental demand for some amount of time, as you get some of these effects. And it's not hard to measure also. Like, you can see the number of flights, domestic and international, to and from China, as well as within China, and flights are down 85% or 80%, something like that. So you need 4x or 5x the number of flights. And that works out to be, just from a jet fuel perspective, the estimate I saw was around 1 million barrels a day just for jet fuel. And jet use is a proxy for a bunch of other oil consumption.
Yeah, it certainly stands to reason that that revenge consumption would overshoot on the upside. In terms of the SPR release, how much of a factor do you think that has been in terms of suppressing the upside of oil so far this year? And then what are the mechanics as to refilling this thing? I've heard a lot of different stories around how the US government will go about it, buying calls and then refilling, or buying oil if it hits below a certain threshold. Educate us on your thoughts on what that has or has not done for the oil price. And I'm just really trying to work out the mechanics of how they refill this thing over time.
So I think it's extremely unlikely that they refill, at least that the current presidential administration refills the SPR. I just don't think, I think it's very unlikely. For political reasons, it's unlikely. For economic reasons, it's unlikely. They want a low gasoline price. So why would they go and buy a bunch of oil and drive up the price of oil by buying it? And they also just believe that oil is going away soon, which I don't believe. I think that's very, very unlikely, but they say that they believe that, and they're acting as if that's going to happen. And even when they're telling oil and gas companies to drill more, they're saying drill more for now. They put the asterisk in, they make it clear that they only want more drilling right now. So they're even, and that sort of undercuts that message. Obviously, you can't tell someone to, go get pregnant for a month. It's not like how it works. I think it's important to understand that, because in the same way as I expect China to stimulate, I expect Chinese people to behave like people have all over the rest of the world in terms of, engaging in more travel and other sort of oil intensive activities. I think the Biden administration is likely to do what they've been doing, which is to try to suppress the price of oil the best they can. And that's inconsistent with the SPR release. So I thought that the SPR release would end up being price positive for oil. And I still think it will be. I thought it was going to have a less of an effect sooner and then a positive effect sooner. And I think like the thing I didn't expect was China to lock down for as long as they did. And that sort of threw off If there was 1 million barrels a day of SPR releases for most of this year, there was about 2 million barrels a day less Chinese oil consumption. And so I think that sort of overcame it. And then there's this other factor, which you mentioned at the start of this question, which was around Russian oil supply. And Russia's oil supply has surprised to the upside, let's say on average since the start of the war, by about 500,000 barrels a day. And right now, it's really hard to tell. So that's another thing that's sort of a blind spot, it seems, for everyone, right? And you can see it with the tanker day rates flipping up and down a lot in the last week or so. We don't really know what the impact of their sanctions are, or that price cap that supposedly we're implementing on them is. But you do know what the impact is of less investment and the technology sanctions and other stuff that were implemented in March, I think, or early on after Russia invaded Ukraine. And so my expectation is over time, even though it's taken longer for Russian production to come off the market, I think we're going to miss, let's say, 1 million to 2 million barrels a day of Russian oil starting a year or so after the start of the war. So let's say by April of 2023, there should be at least 1 million barrels a day less of Russian oil supply than there was shortly before the start of the war. So let's say February this year. And right now, at least in November, they exported the most that they had exported since January of this year. So they sort of, and maybe that was timing around the price cap. Maybe that was, they actually were producing that much. So it might be coming from their sort of local inventories. It might have come from actual production, but sort of either way, it looks like that production is declining. That matters because when you look at the SPR, and even if you think they keep releasing the SPR, there's still a few 100 million barrels. They could, in theory, the Biden administration could just continue to release it at 1 million barrels a day, and they could do it for another year, essentially. Even if they did that, if Russian production is down by 1 million barrels a day and Chinese demand is up by 2 million barrels a day, even if you use some of the most extreme demand losses from estimates from slower world economy and various other considerations, you're still in an undersupplied market, even if there's a 1 million barrel a day release from the US SPR. So, and that's where, like, on one hand, it's really disconcerting to realize that, hey, some of these inventory models maybe weren't so correct, and that there's some uncertainty around what's currently in storage, as well as what the supply demand balance was precisely over the last number of months. On the other hand, there's these sort of big factors that everyone knew and everyone was talking about when oil was at 130, and now everyone has just, not everyone, almost everyone has given up on and sort of said, hey, yeah, these aren't real, or are almost bearish factors that they're using to go short oil or sell oil positions.
Okay, that's super interesting. Last question on price. We've focused a lot on price for oil today. Listening to Eric Townsend during the week, he had an interesting point to make around the futures market, where you have a situation, we've gone from being in backwardation now into contango for certain parts of the curve. And once you go from backwardation to contango, you use that positive roll yield, and now you start to have a negative yield, and that seems to have caused traders to dump a lot of contracts towards the front month, which obviously brings down the near-term price. How much of an effect do you think that has in terms of the financial market driving the physical market? Is it a case of like the tail wagging the dog, and this sort of short-term trading combines with some of the macro factors that we've mentioned before? Do you pay any attention to that, or do you kind of discount that as short-term volumes changing the front end of the curve, and you're not so concerned with that, you're more concerned over the longer period of time?
Yeah, so it's the sort of thing that I'll like look at, make sure to understand and pay attention to. I think there's a number of different narratives around futures markets and the behavior of traders in those markets, and how essentially they call them paper barrels affect the price for the physical market. And, most of those I'm inclined to just dismiss. And the reality is that in an undersupplied market, if we were undersupplied, how I think we will be in a year, with much less Russian production, much more Chinese demand, and as Chinese demand comes back on, I think there's room for significant economic activity, not just within China, but between China and various other countries. China isn't done. I think they have a lot more room for stimulus. How they fund it is complicated, but they can do it if they want to. And various other countries around the world are engaging in large scale fiscal stimulus. So I think there's room for there to be really significant demand. So if that were the case now, none of these narratives around market structure and whatever, like none of that would matter, because you just see all this oil disappearing and you'd see much, much higher prices. And that's one of those things where we did notice this, and we're not speculating on short-term price movements, and we're not active in trading in short-term oil contracts as well. But you could see that there would be these big oil inventory draws announced by the EIA, and the price wasn't moving, or it was going down, not up. And it was sort of this joke about a bearish oil inventory draw, when that should be very bullish to see, let's say, 10 million barrels disappear in a week.
One would think.
But yeah, or more, right? But it's sort of a bad joke. But the reality is that it wasn't disappearing from the world. It was disappearing from the US and from our SPR, and it was reappearing in Chinese SPRs. And people get very upset about this, and like they say it's very political, but it's not that complicated. If the US SPR is down by like 200 million barrels this year, and if Chinese government-controlled storage facilities have increased their storage by, let's say, 200 million, it's like, again, we don't know the exact number, but let's say directionally by that amount. I mean, you can say, oh, it's fungible, which it is, or you can say, hey, there's one SPR that's down 200 million and there's one that's up 200 million, and just make it really simple and call it that. And I don't think that's necessarily political. I think it's just sort of accepting a reality, which is a shift in strategic reserves from one country to another.
Okay, fascinating. I'd like to move down from this top-down view and macro into some of the, I guess, the meso and the micro questions that I have for you. You've written some fantastic articles, both for Bison newsletter and also in Seeking Alpha. You've spoken a lot recently around how the way in which Warren Buffett invests today is not necessarily how he would have invested if he were younger, running a smaller fund today. I would love to get your view as to where you see the value in the oil and gas sector specifically. You've written a lot about the smaller cap side of things. I'd like you to talk about why that is, and why people, I guess, riding on the coattails of Buffett buying Occidental Petroleum may not necessarily be choosing the best value opportunity in the sector. And then we'll lead in from there. So where are you seeing the value as it pertains to the oil and gas sector currently?
Yeah, it's a great question. I mean, I've talked about it and written about it before, and yet our monthly note, which hopefully is coming out on Monday, is going to be about this, because I think this is just not well understood, and I don't think I can talk about it enough, because people aren't hearing it. So let's just
well, you have a platform, my friend. The floor is yours.
Thank you. Yeah, no, I feel like this is just. I mean, so part of why I was talking so much about macro is that you asked, and part of it is that we get such intense pushback. So the more oil prices go down, the more sort of vocal people who are bearish on the oil market get. And whether they say they're bullish or bearish, they just, you can kind of tell, because they get really negative as price goes down. And one message I got from someone who I guess I'd categorize like that was that I am not Warren Buffett, and therefore I need to sell when price goes down, because price might go down more, and I need to be able to buy if price goes down more. And I can't say I'm not being fair to them, because I don't know that I understand the logic there. It's certainly not what a value investor would do from an investment perspective. And it's certainly not what Buffett ever did in his career. But I am not Buffett. So we'll be clear about that, right? Like, Buffett by my age was much wealthier than me, and he was much wealthier in 1960s dollars. So, I'm not Buffett.
But less handsome, Josh, less handsome.
And maybe I don't know. I appreciate that. So I'm not, but I don't think that you need to be the people that you learn from and that you emulate. You can just learn from them and emulate them and do the best you can. And so I I don't think that copying them is a good idea. And I don't think that copying them when you're in a totally different, let's say, life stage, and totally different investment or career stage than them. So in the same way that you wouldn't necessarily copy Buffett in drinking several like cherry Cokes every day, that's probably not a great idea.
Definitely don't copy the diet.
Yeah, you don't want to copy their debt. You probably don't want to copy their current investments. And none other than Warren Buffett has said this, where he's talked about how if he were managing much less money, and like I think he said this a number of different times in a number of different ways, but I remember I've attended Berkshire twice. The first time I went with Morgan Housel and his girlfriend at the time. Now they're married and have kids. And someone asked Buffett about what he would do if he were younger and investing, and he talked about how he thought he could compound money at 50% a year by investing in small and microcap stocks, and that people should not expect Berkshire to accomplish anything close to that because he's responsible for so much money. And he's not going to like return the money and go invest $50 million. But at that size, he had the strong view that independent of market cycles, independent of the economy, that over time he'd be able to compound money at a very, very high rate. And he was using it to try to like reset expectations down for people in terms of investment performance for Berkshire. So when you hear him say that, and then you see him go buy Occidental Petroleum or Chevron, you understand, okay, these are companies that meet his liquidity parameters. And there aren't companies that are that size that meet the sort of valuation parameters that he had 30 years ago, right? These are things, the stocks are at, let's say, 6 or 7 times EBITDA. They have, they might be at a premium to their proved reserve value. They have limited drilling inventory relative to their total production. There's different metrics to understand sort of what their intrinsic value is. And yet he's buying them anyway because he has to buy bigger stocks and he wants that exposure. So, you get a ton of pushback talking about this. I get a ton of pushback talking about this because people say, oh, well, Buffett's buying Oxy, therefore it's good. And it's not bad, right? Like he clearly did a lot of work and he's the best living investor with the best track record. So it's worth learning from. But it doesn't mean, I think it also makes sense to listen to what he said and to observe what he did, let's say 50 years ago when he was managing a lot less money. And so from those perspectives, if you look at what he's done historically, which is buy good businesses at discounts to the fair value, you can find Occidental Petroleums that are 1/100th the size or 1/10 the size, and you can find them at half the cash flow multiple and at half or a third of the price per barrel of oil in the ground, and various other interesting metrics that are heavily discounted. So I understand why people copy him, but I think it's better to emulate him rather than try to precisely copy him. And the set of things that you can invest in that are similar to what he's buying are small cap public oil and gas producers, as well as small cap oil and gas services companies, which are both at very big discounts to replacement cost, very big discounts versus Oxy or Chevron or other large cap producers and integrateds. And that much more closely fit what Buffett would do 50 years ago, 40 years ago, when he was managing much, much less money.
Yeah, absolutely. Of course, there are nuances involved, guys. And if you are running 50 million versus several billion, obviously your liquidity needs are going to be slightly different. And that's going to place restraints as to where you can and cannot allocate your capital. So it makes more sense to emulate Buffett's principles as opposed to simply blindly copying every trade that you can read on a 10K. I would love to delve in a little bit more now into the nitty gritty and geek out about some oil. Well, not necessarily oil, but value investments. When Josh Young sits down at his desk and he looks over an investment case for any particular company, but in this case, we're focused mainly on oil. How do you, what's the hierarchy in terms of looking at the company? How do you value this company? Are you looking at reserves first, or are you looking purely at cash flow yield? So looking at whether it's cheap on a cash flow multiple. How do you balance up the reserves of the company? I've heard you talk about low decline rates and why that's important versus the cash flow side of things. I'd love you to take me into your mind when you sit down and you look over an investment case. what's the step one, what's the step two, what's the step three, and why are they in that particular order?
So every investment is its own universe from my perspective. And so every investment thesis has to stand fully on its own merits. And there's almost nothing that I'll own or that I'll invest in where it's almost identical to some other thing. And then there's just some slight difference in cash flow multiple or slight difference in discount to reserves or corporate production decline rate or so on. So because each one of these are so different, there's not really a great answer in terms of what comes first. I think in terms of metrics, I think people mess up a lot on cyclicals, and they measure them by measures like cash flow or measures like reserve value. And those things matter, right? And I'll cite them and people can more easily understand them. But I think just sort of the general high level heuristic for value investing in cyclical industries is to invest at large discounts to replacement cost, or essentially book value, but book value is not so great because of E&P accounting. So what would be book value in other industries, to invest at a large discount to book or tangible book, and then to sell when you can get a reasonable multiple on the sale. And so it's really hard to explain that to someone, because the idea of investing in something at a discount to replacement cost really doesn't resonate. People don't, they think of, a tech company, or they think of a, office building, or think of whatever. And they think, okay, well, you can't buy any of those things for anywhere close to what they cost to make. You have to buy them for 10 times or 20 times or whatever. And so I think, at least from where we've gone to from a general market investment paradigm, this idea of investing at a large discount to replacement cost, really, it just doesn't, it's almost like not in the parlance. It's not in the vocabulary. So that's, I guess, the starting point is like, is this thing of substantial value relative to the current market value? And then,
and you're looking at, from tangible book, you're looking at, the assets and the liabilities, including like the steel value. Are you taking into account reserves there, or that's a separate issue? You're just looking at the tangibles and whether you can buy that at a large discount to those tangibles on the book value.
Yeah. And again, like, it's not the accounting measure of book value, because the accounting measure gets messed up a lot when companies write down their reserves, for example, or write down infrastructure in economic downturns or cyclical downturns. So you end up with very weird accounting that doesn't reflect the actual replacement cost or the real book value if you were to mark everything to the current commodity price, rather than having marked it down. And then generally you don't mark things back up. Actually, that's like one thing to watch out for as a red flag. When an E&P company or similar marks up the value of their assets, that is a non-standard accounting approach. And the one that comes to mind that did that was Miller Energy, which was essentially scam that was operating in Alaska with a US listing, and it went bankrupt, shockingly. And like they took a 400 million write-up after they bought an asset. Like, it wasn't even an asset they had owned for a while. They bought it and then wrote the book value up from, they paid 50 million or something, and they wrote the book value to 400 or something. So that's, I think, an example of why using the accounting book value is maybe not the best starting point for that. But yeah, in terms of the replacement cost, I think about it in terms of, how much would you have to spend to get the set of things that the company has? So it would be drilling wells, it would be, for a producer, it would be buying or building infrastructure, or arranging with a third party to have infrastructure built if they own it or don't own it. It would be getting the permits and getting all the access to do whatever activities are necessary to replicate it. For services companies, it would be not just building the equipment or buying it at whatever sort of stage of its maturity. Like a 5-year-old drilling rig is obviously not worth the same as a brand new one, but it's also not worth the same as a 15-year-old one. So you have to adjust your replacement cost estimates based on the useful life of the equipment. But it's not just that. You'd also have to hire a crew, right? If it's working, you'd have to get an experienced crew and get them working about as efficiently as the crew is currently working. And then if you have contracts, you'd have to somehow get those contracts. So there's more that goes into it, and it's sort of complicated, but just very high level. When you look at cyclical businesses, when I look at cyclical businesses, the way I get comfortable from a value perspective is just buying at a large discount to what it would likely cost to replicate what they have. And, maybe you don't need to have that particular oil field, but like the oil field down the road with similar decline rates, or that particular, drilling rig, but you could have a very similar one, or so on. And so I think that's sort of my starting point. But then there's a balance sheet question, like, can they survive if prices go down and stay down for a while? And then team question, who are the people and have they done it before? How good are they at doing it? And then also obviously valuation, not just from replacement cost, but how does the valuation compare to other businesses? So it's generally not a, hey, here's this company and that one, and they're really, really similar, but here are the slight differences. But it is helpful to understand from a comparable company sort of benchmarking valuations across a whole set of companies to try to not dramatically overpay, even if there's something special about one of these companies, to try to make sure to, at least from an entry point perspective, to pay a reasonable price or a big discount relative to comps. So sort of in that order, but it's very complicated by getting those sort of replacement cost estimates, figuring out sort of what assets are likely to generate from a cash flow perspective, identifying potential buyers, and sort of understanding holistically like what the value proposition is and the margin of safety and so on. It's really hard to say what exactly comes first, and it's usually more of like building out a mosaic than just going down a checklist.
No, that was a fascinating answer. My mind is spinning, and I think that the detail into which you went shows you where you get your edge, rather than just pulling up a bit of software that says, okay, well, it's the book value says that it's X. There's a little bit more that goes into it in terms of figuring out what it would cost to get that company to its current stage of operations today. Here's a curveball. Inflation in terms of equipment, and then you mentioned the labor necessary to operate these kinds of operations. How the hell do you factor in the wage inflation, the cost of goods inflation, piping, all that sort of thing? Is it just you do the best that you can, you look at change year on year from last year's expenses to this year?
Yeah, I mean, it's hard. It depends on what exactly you're measuring, but you have to, there's a lot that goes into it. And then it's not just, you can't just use like CPI or something similar to that, because there have been wild swings in drilling pipe costs over the last 18 months where they went way high and now they're starting to come down. And certain specific pipe went up in the secondary market 200 or 300%. And then now is down, let's say 30 or 40% in those sort of same secondary markets. The primary, like if you're buying it from Tenaris or someone like that, the price that they were charging, I think they raised it by like 30%, but it's more similar to what happened in the used car market, right? Where like prices went nonsensically high for certain kinds of used cars, and then now recently have been coming back down. So there's two-way price movements. There's different markets for the same products depending on your ability to source those products, and then how much, I guess, from a time perspective, how urgent your need is for those products. That'll dramatically affect your price as well. So it's really I don't think I ever really come up with a precise, oh, it would cost like X number of hundreds of millions of dollars to replace this oil field or these drilling rigs. It's more, hey, using these heuristics and sort of this range, is this at half of the replacement cost? Is it at a tenth? Or is it sort of in the ballpark of around what it would cost to replace it? And then even, I guess, like one other aspect, sometimes it might cost less to replace something than we're paying for something, or than the current value is on an existing holding, but there might be something unique about it. If there's some edge that a company has, if they are the dominant supplier of certain kinds of services, or if they have all of the land in a certain kind of field, or they have some other stuff, that could maybe be attributed to replacement cost, and maybe you just need to bump that estimate up. Or you can just say, hey, this thing is worth more because of this reason, and just allow that to be considered from a margin of safety perspective. So that's like maybe the closest that we'll get to like new Buffett versus old Buffett in terms of, that valuing some of the non-tangibles, but it's almost always starting from a heavy discount to the tangibles. And then, if it's with a team that's compounded money for people over their careers very nicely, that helps. And then if they're executing their strategy, that helps. And then if they're on sort of a trajectory where there are some intangible factors that increase the odds of success after they've had success doing the thing they're doing, or they get certain financing backers, or they get some other stuff that sort of increases their chance. Definitely that's something that we'll consider. And I think that affects less the valuation on entry and more the sell decision, and timing, as well as discount or premium on selling the holding.
Okay, yeah, so that steep margin of safety allows for you to be roughly right as opposed to being precisely wrong in some aspects. All right, guys, it's ROI time, and this is where I get the chance to delve into some of Josh's past investments. I would love to ask you, what is your highest return on investment from any investment to date, or your favorite for whatever reason, one that sticks out in your mind? Maybe give us a little bit of a background, and if you have any numbers handy, that'd be great. But be fascinated to hear what some of your big wins are from an ROI perspective.
Sure. So it's always, we were doing this since 2015 for Bison. And so it's a little, what people will see as they find out about Bison from, let's say, post-COVID might be a little different from sort of the total return achieved, because, stocks that say oil and gas stocks, I think since we launched XOP, the oil and gas ETF that's for large producers, is down about 25%. So the average, or not, the typical company sort of in our universe that's maybe a little bigger, is down about 25%. I think the small ones are down about 40 or 45% since we launched. So in that framework, things are a little different than in the framework of post-COVID, where the typical oil stock might be up, let's say, 300%. So I think it's important to sort of benchmark things. So one that I think is probably my favorite investment right now is Journey Energy. And I know I've talked about it a lot, but I think just from the framework, I don't normally really talk too much about this sort of replacement cost approach, and sort of marrying that with the sort of new Buffett, business with a franchise essentially that's able to sort of grow in a meaningful way and expand its multiple, and sort of achieve some of like the nice things that businesses can achieve when they work well. But so Journey, I think the bulk of the position. That I have, the cost basis was like, I don't know, something like $1.50 a share, and don't hold me to that exact number. And there was stock I had to sell when a major client redeemed a few years ago, and there's other stock that I bought at different prices. Those stocks at 5 or so right now, so that's been a great investment. But it's one of these weird things where sometimes a stock's up 2 or 3x, and it's really time to go, right? That's the sort of potential return has been achieved, and that's it. And, I'm a taxpayer, and I'm a large investor in my strategy. And so I kind of prefer not to have that happen. I prefer to be in something where, the share price goes up, but the intrinsic value goes up more, and there's a trajectory for that to continue. And so, and people don't like to talk about taxes a lot. I guess Buffett does. So maybe that's, again, like, I'm not Buffett, I get it, but he doesn't like to pay taxes. No one likes to pay taxes. It's worth, within the confines of the law. And so one way to reduce or defer your tax liability, and this isn't tax advice for anyone, but like one way I do it is by holding a stock for a while. And so since I bought Journey, they've transacted about 10 times. They've bought and sold assets. They bought back their debt at a large discount in the middle of COVID. They've done really interesting infrastructure deals, and they're set up right now where if you tried to replace them, it'd be real hard. You'd have to go try to buy assets that are declining at, let's say, 10 or 12% a year. And there's not many of them. And it's pretty hard to accumulate them and accumulate ones that perform like the assets that they have. If you tried to replace it by buying fields and developing them like they have, it would be very, very expensive and very difficult. So there's a little bit of a, it's not totally different from other oil and gas producers, but it's different enough that there's the replacement cost would likely be, let's say, I don't know, 2 or 3 times sort of where it's trading. But where it's interesting is that they've been high grading their asset portfolio ever since I've owned it and since before I was involved. And as they do that, they're starting to get a little recognition for it. And their multiple hasn't expanded yet. It's actually very weirdly a very cheap stock, despite having
something like 2 times the cash flows at the moment. It's ridiculously cheap.
Yeah. I mean, depending on your oil price assessment and so on, it's a very, very low cash flow multiple, but also a very, very big discount on reserve value, on PDP, so on the actual production. And then one of the interesting things about Journey that's different, and again, I own the stock, this isn't a recommendation, but you're asking, hey, like what's done well? And it's so great to own something that's done this well and have it be positioned like this. But they're set up to replicate some of what they've done that's allowed this stock to be a multiple times return already. So they started a power business. I kind of nagged the CEO for a year or so, and then he started doing it. So I'll take a tiny bit of credit that I bugged other management teams. Shout out to Alex. I was invested in, and they didn't do it, and Journey did it. And they've created probably at this point $100 million of value from investing maybe $15 or $20 million so far. Actually, probably a little more right now. Maybe they've invested 20 or 25 million so far in their power business. And it's great because it's this organic business, right? They're buying gently used large scale power generators. Well, they're large scale for a small business, but they're small relative to utilities. And they're going and buying, 4 megawatt, 5 megawatt. They just bought a 14 megawatt power generator, and they're installing them at their fields, and they're replacing their consumption of grid power, which is very expensive in their jurisdiction in Alberta. And they're replacing it with their own gas. So there's huge synergies, and it dramatically lowers their operating costs, but it also creates a business that is worth, I don't know, 8 times to 12 times EBITDA. And that multiple is very different from upstream oil and gas multiples, because that multiple is probably not going anywhere. Like, it may vary a little, but utilities tend to have very, very stable earnings, and they tend to trade at very high multiples. And so Journey is basically they are creating an independent power producer within their business. They've compounded money in this business at a rate that's extraordinary. They've executed on it. There's only a few competitors of theirs that are doing this, and they've executed way better. They've gotten their projects done on time or nearly on time. They've gotten them done at cost or nearly at cost estimates versus competitors that have come in way higher. And so they're sitting on this business. They have a few $100 million market cap. Actually might be a little less after this recent pullback. And they're sitting on a business that they started with almost no money in, with a huge runway to be able to grow it 5x, 10x, whatever, on their existing footprint. And they get zero value for it, right? They're at a low multiple on their E&P, and you get their power business essentially for free. And it's this thing where, like, the same people are doing this, right? It's not like they're stopping their power gen, and maybe it'll take a little longer, or maybe they won't grow it by as fast a rate as they're growing it. But so far, it's been growing over 100% a year from the initial installation, and it might grow even faster than that. So you have a high multiple, high growth business embedded in a ultra low multiple, low decline E&P business, and it's like, hey, like, this is not your normal oil and gas company, and yet it trades at a discount to, or in line with most of its comps. And, again, like back to Oxy, right? So you can own Oxy at 6 or 7 times EBITDA. They have some CO2 sequestration stuff, but it's very expensive and very uneconomic. And they've already, it looks like, wasted almost $1 billion building out stuff that doesn't really work. Or you can own Journey, where at like 2 times EBITDA, with a business embedded that's rapidly growing, that probably should have, let's just say, a 10 times multiple, but maybe it should have a 30 times multiple because it's growing at 100% a year. And so, and yeah, it does cost money to grow, but they have this big footprint. So anyway, I think it's just super interesting to have something like this, right? I'm sitting on it. I've been buying more stock every day pretty much for the last like month. As it's pulled back, it's like, hey, they just announced this 14 megawatt project. They're implementing it. They have more on their way. So yeah, I think it's great to own something that's up multiple times, even with all this volatility. But it's even better to have this sort of thing where, you know, they're doing accretive upstream acquisitions, but they're growing, which is nice. And, you know, just for that, they should probably be at a 4 times EBITDA multiple instead of a 2 times for their upstream operations. But then they have this whole other business that people, it almost looks like the market's discounting the business, giving them like no value for it. And it can very easily be worth the entire market cap over the next few years. And then, I don't know, maybe they spin it out, maybe market recognizes it. But yeah, I don't know. It's a very weird, interesting situation. And that's one, I mean, I've been very vocal about it. People have like, you know, I get sort of mixed feedback on that in terms of, oh, you're pumping this stock. And it's like, but so I talk about it and then I go buy more. Like, it's a very, very odd pump scheme. There's no dump, and there's just there's a talk about it and then realize I like it even more and buy even more of it. But yeah, it feels very good to own something where it's up and to the right, and the value build. And it's not See's candy or anything like that. But again, just that Buffett analogy, the Buffett thought, like this is something that can be worth radically more money over the next few years if they do nothing different from what they're already doing, if they're funded in no other way different from how they're already funded and already, you know, growing their business. And there's just so many different ways, whether it's oil price upside or natural gas price upside or power margins or just growing this power business while keeping the rest of their business flat and generating huge free cash flow. I mean, there's just many different ways to win, some of which are not available under almost any other company within sort of the whole public and private oil and gas investment universe.
Yeah, absolutely. And disclosure, guys, viewers of the channel know that I've owned Journey shares for quite some time now, for those reasons like management, value add, operationally, and then through acquisition. And I was going to ask you if you thought that they would eventually spin off that part of the business for which they're receiving no credit. It'd be interesting to see. I think you've certainly answered my next question, which was one of your highest conviction stocks. I would just like to ask you briefly before we wrap it up as to where you see or how you see E&Ps versus offshore services or oil field services. So if you've got these three, you've got E&P, you've got offshore, and then you've got onshore oil field services, with this idea that, you know, eventually, unless we're going to run out of oil, we're going to need to increase CapEx. That CapEx is going to flow through as income to these oil field services, right? So where do you think, are you interested in the offshore space at all? Because some of those appear to be trading, like you said, at a big discount to replacement value, and potentially on this re-rate, they might trade at multiples of cash flow, which would be nice. Interested to get your thoughts on that before we wrap up.
Yeah, absolutely. So I think we're getting close to the point of a cycle where incremental movements in price, let's say as we get back to 85 or 90, above that point, I think that margin starts getting taken by services and is lost to E&Ps. And so generally to the sort of average large cap E&P, we're getting close to the point where I think they're closer to fairly valued and they're less interesting from my perspective. So the smaller cap ones at like 2 times EBITDA, 3 times, 1 times, whatever, those are still very interesting because I think there's a lot of room for multiple expansion. But from a business margin expansion perspective, I think there's much more room for services margin expansion than there is for E&P margin expansion once we're back at sort of that $85, $90 oil number, similar for gas at, let's say, $5.50, $6 gas in the US. So from that perspective, I think services is more interesting. The problem is that many of the services businesses are also not cheap. And some of them are very inexpensive relative to replacement cost, but even among the ones that are at a discount to replacement cost, some of them have issues with their fleets. They built stuff in a different sort of investment era. And so some of their fleets, for some of the offshore drillers, for some of the onshore, for seismic and other sorts of businesses, that there's a lot of risk of obsolescence, as well as a risk of sort of malinvestment historically, where they might look really cheap on replacement cost, but if your certain kind of offshore drill ship is just not so relevant for likely activity in this next cycle, your replacement cost might be high relative, but it's not really, that's not, you don't, if you don't want
You
to
can't count that
it,
as an asset because you're not going to be able to use it essentially.
yeah, or you're going to get a much lower rate or whatever. So I think I have exposure to both onshore and offshore services. I think that a lot of caution is merited. And then on offshore in particular, there's a unusually high risk of liability, where if you had another Macondo or other sort of event, you could have sort of a double negative, where you'd have specific potentially business killing liability, at least at this part of the cycle, where the balance sheets for these companies, they're pretty clean, but they still don't have the capacity to be able to fund the sort of cost that Transocean had to bear on the Macondo incident. So that could be company ending. So there's a big concentration risk.
And they can't get the insurance that would be adequate, right? Like they just can't.
It's impossible. Yeah. You end up and depending on the sort of situation, even though it almost definitely was BP's fault, pretty much exclusively, it still ended up costing Anadarko, and it still ended up costing Transocean. It's not fair, right? Like the Transocean people were doing what they were being paid to do, and they were mismanaged, and they still ended up on the hook for a lot of money. And so using that as sort of a reasonable starting point, it's an unreasonable liability allocation, in my opinion. But it was that was just how it worked. So I think I use that as a heuristic for expectation of liability. So I try to not have too much exposure to any one offshore drilling rig company. And I'm biased towards the post-reorg drilling companies, where after they've been through bankruptcy and had their debt extinguished, they're much less likely to have a sort of insolvency type event or a major dilution event, both in general and in the particular situation where there's some sort of operational problem. And these things happen every 5 or 10 years. And as rigs get brought back onto work, unfortunately, there's a elevated safety risk when you bring on rigs and other equipment onshore and offshore. And so, I think it's something that I'm trying to be very cognizant of and cautious with. And so I've tried to diversify my exposure, especially on offshore, and then also avoid companies that have a lot of debt. And then secondarily, as you can probably tell, I'm not really a big fan of companies that issue a lot of equity just to survive. And so some of the offshore drillers, along with some other services companies, are very active equity issuers. And I'm sort of more of I'd rather a company grow more slowly or shrink a little, but issuing tons of stock without a clear, so like Journey issued some stock, but they ended up with 40% more production. They improved their decline rate. They improved their margins. Yeah. So I think there's some risk there. And then on the onshore services side, I think it's tough because some of the valuation differences are driven by business quality differences, and then some of them are not. And so there's just a lot of work to figure out exactly which ones to get exposure to. We've done that work. We're really excited about our exposure, and we've been continually adding to that exposure. I think onshore and offshore services should be, like I was saying, they should be the margin winners, and typically margin winners are the stock price winners over time. And so I think the prospects for those areas are very promising. And then sort of weirdly, the small cap E&Ps, by this point in the cycle, they should all be at 4 or 5 times EBITDA, and they're at 1 or 2 or 3. And so it's almost like a gimme, where like those should just catch up. And then once they catch up, then it gets much more interesting for me to go redeploy some of that capital into even more to services, where it's hard to know what the exact re-rating dynamic will be. But if things continue out how they have, I think there's a decent shot that the small cap producers sort of continue to outperform, get closer to that sort of 4 or 5 times multiple, and then get way less interesting to me, similar to the mid cap and large cap producers currently. And I think there might be sort of a longer, bigger runway for the services companies, especially because so few people talk about them. They're very under-owned, and there's as much of a CapEx gap for services as there has been for upstream.
Okay, that makes sense. It might be the further out of ripple effect. Those offshores might be further out than the E&Ps. And I sneak one more question in. I forgot to ask you about emerging market players that seem ridiculously cheap, with the narrative being there's a lot of jurisdictional risk. If I throw a few names at you, like Petrobras and Ecopetrol in Colombia, do you have any exposure to anywhere outside North America? I'd be interested in your response as to how you view these types of.
I don't really want to talk about specific names. I do have exposure to foreign producers, but I'll highlight one that I'm not exposed to, that's been heavily touted, that isn't working for reasons that people identified from a geopolitical risk perspective. And it's PetroTal. So I don't have exposure to it, and I'm also not short it. It's just something where it was very easy to see that a oil producer in Peru would have substantial geopolitical risk. And there were a whole set of people who own it or owned it and advocated for it, emphatically argued that there was minimal geopolitical risk, that Peru was aligned and whatever. And very recently, they discovered that there are problems with getting their oil to market. And they had supposedly come up with this unique solution, which was, instead of to take it by pipeline, they were going to barge it, and that somehow would avoid problems. And lo and behold, the barging is a problem too, and their production's down 75%. And, I'm rooting for them, right? Hopefully they're able to work it out, and hopefully the local indigenous people are able to get reasonable compensation for the disruption of their land and so on. Like, I'm not advocating for anything sort of extreme there, but those sorts of risks are real and significant. And when you think about some of the names you mentioned, along with others, there are real risks in every geography, in every country. There's Western Europe has turned out to be a catastrophic risk to equity holders of these businesses that are active there in oil and gas, with these enormous windfall profits taxes. So, every country has its risks. Every company has its risks. And I think it's just important to be able to carefully evaluate those risks with open eyes, and to try to be more imaginative about the risks than about the upside. And I feel like you don't really see a lot of that. It's not sexy. It's not fun to talk about. But if you just think about, hey, what are all the things that can go wrong? Like, what am I missing? Why am I so lucky? I think it's really helpful in terms of screening out some of the things that people might argue are really compelling, or that you might think are compelling. And then, and sometimes stocks are cheap enough that you understand there's a high risk, but it's on a risk adjusted basis really compelling. And then, one of the ways I'll navigate that is, generally I like to be very concentrated in investments, because I do a lot of work, and I find that I do better if I concentrate investments. But for higher geopolitical risk areas, I found I'll take the exposure, but I'll just go a lot smaller from a size perspective. So hopefully that's helpful. I don't really want to get into sort of specific international names that I have exposure to, but just like highlighting a situation where you could see the structural problem with where they were, and the local dynamic, and it just continues to play out from a negative perspective. And then understanding, I think, that rules can change in any place, and that sizing, I think, can help address some of the risks around that.
Absolutely. Very practical way to manage geopolitical risk, and being more imaginative about the risks than the potential upside. That was something that's really stuck out for me. Well, thank you so much for coming on the channel. Would love to catch up with you further down the track and see how all this has played out. Is there anything I've missed, or is there anything that you would like to add before we finish up here?
Well, just a little. So we talked a lot about sort of the short term for oil, and then also the medium term. The whole thing, and I've talked about this before, but I think it's worth just mentioning just for a minute. The big thing I'm looking for as a value investor in oil is, obviously I want these things at big discounts to replacement cost, at low valuations, and to own them as they revalue. But there's also this almost value investment type dynamic for oil, where there's this underinvestment in the sector that's sort of built up over time. It was our initial thesis for Bison. And as there's insufficient investment for longer, there's sort of this like pain trade for oil and for oil and gas equities and the services companies, where the less investment there is, the less supply there is with a lag, the higher the price needs to go in order to incentivize enough investment in order to get enough supply. And so I think there's a lot of push, and I think this is very poorly understood. And so it's part of why people care so much about what the exact inventories are, or, is China building a little, or are their inventories falling a little? But it's, I think, really important to keep in mind the sort of the capital cycle and where we are in that cycle. And yeah, oil prices may fall a lot because the world economy falls apart. They may fall a lot because Russia somehow manages to get their oil out, and China may stay locked down for longer. There's always those risks from a short-term perspective, but you're early in this capital cycle where there just hasn't been nearly enough investment even to sustain current production rates. And so I think understanding that makes it a lot easier to accept short-term price volatility and just say, hey, I can be wrong. I'm going to try not to be wrong, but I can be wrong about some of these short-term things, and they kind of just don't matter in the scheme of this massive multi-year underinvestment where, is oil going to be 60 at the end of this year? Is it going to be 100? I honestly don't know. And I don't know what it'll be at the end of Q1, but it kind of doesn't matter, because 3 years from now, oil is going to be a lot higher. Maybe a year and a half from now, it'll be a lot higher. And it's going to be a lot higher because of that underinvestment. And there isn't really a shortcut in between where we are and much lower sustained oil prices without large scale sustained investment. And so you can't skip from A to Z without hitting some of those middle letters. And we haven't hit those letters. So that by definition puts us early in the cycle rather than late in the cycle.
Yeah, we'll be definitely keeping an eye on the CapEx cycle. And once you see those rig counts start to come up, then the next question will be, when do we start to exit? Maybe we can cover that on another day. Thank you so much again, Josh. Guys, if you haven't already subscribed to Bison Interests newsletter, it's fantastic reading. I highly recommend that you do. Link will be in the description, along with Josh's Twitter and social media details. Thanks for watching, everyone. You've been listening to the ROI channel. Please like and subscribe. Take care, and I look forward to catching up with you with another episode shortly. Take care, everyone. Bye.
Thank you.